This is BullionMax, the podcast. Hi, I'm Mark Alyn. And if I haven't said it before, welcome to 2023. I can't believe it's already a new year. Along with me is Sean Reynolds, the customer service manager for BullionMax. Happy New Year, Sean.
Happy New Year to you as well, Mark.
We're going to take a look with David Hay, who has written a book. It's called Bubble 3.0. History's biggest financial bubble, who blew it, and how to protect yourself when it blows apart. We talked to David just a couple of months ago at the end of October, I believe, and we're going to get some prognostication from him as we mount 2023. David, welcome back.
Well, thank you, Mark and Sean. Great to be back. And boy, prognostication, that's a big word. Maybe I'll just stick with forecasts.
Yeah,
Fair
all right.
enough.
Well, we could do that.
Whatever makes
Oh,
you
Yogi
comfortable.
Berra said, right?
Yeah.
Always hard to make predictions, especially about the future. Well, let's just keep that one.
Yes, especially about the future.
Well, let's take a look at where we are right now. As we know, interest rates are up. Gas prices may be coming down a little bit. At least they are here in California. The market has been tanking. As we record this in the last part of 2022, the market rallied a little bit, at least earlier today as we recorded. I don't know if it's lost its momentum or not. Where do you think it's going to go, David?
Well, first of all, I wanted to say even though the market's been struggling a bit since October, it had that great rally from mid-October kind of to early December, and then it's really come under some pressure at the end of the year. But what hasn't is your favorite plaything. So you've got and we talked about these positively back on October 24th. The GDX, the gold miner ETF, is up about 20% in that period of time. And the gold itself is up about 10, and silver, which I think we like the most actually at that point, is up 24%. So doing really well in a not that great market environment. So congratulations, guys, on highlighting those when you did. As far as going forward, I think it's gonna be a very interesting year. Typically at the end of the year things are kind of quiet, but right a couple days before we recorded this, what happened in Japan is huge. It's seismic. Where for years the Bank of Japan maintained that interest rate peg, yield curve control at 25 basis points, 0.25% on their 10-year Japanese government bonds. They let it double, which it pretty much immediately did, and it triggered a huge rally in the yen, which has actually also been gold supportive. And so I would suspect that we're going to see more of that type of thing, where a lot of these government shenanigans are coming home to roost. Things like interest rate suppression and yield curve control are going to be harder for them to pull off. I think, frankly, government financing is going to be hard to pull off, including for the United States this year. So I think what's we're really leading up to at some point during 2023 is the Fed, however reluctantly, needing to get back into QE mode, quantitative easing, where they're basically monetizing the government's deficits. I think they're going to fight it tooth and nail. I think it's going to not be a first half 2023 kind of event. So I think that's likely to make the first half of 2023 pretty rough for a lot of asset classes, because I do think we're going to see a recession. And we've got a heavily inverted yield curve. We've got the Fed tightening into an economy that's increasingly looking recessionary. I think corporate earnings are going to get hit hard. Wall Street's looking for a 5% increase next year, which I think is absolutely, they got to be smoking something that makes them feel good at night. But I think we're going to see more like down 15 to 20. So a major delta. I do think inflation is going to look soft in the first half of the year, but I think earnings are going to look softer. So investors have been ardently hoping for a peak in inflation, which they're getting. But I think it's the classic case of be careful what you wish for. You might get a good and hard, because what's going to come with that is also a fairly significant earnings recession. I've got some pretty high quality company, particularly Mike Wilson from Morgan Stanley, who I do think is the best Wall Street strategist. So that's a little bit of a take on what's coming for next year, I think.
Let's take a look now. This recessionary period is weird. At least it is to me.
It is.
The economy seems to be robust to me. I went to the mall the other day, and when there's a recession, people don't go to the mall. And I couldn't find a parking spot for 15 minutes. And I said to myself, what are they buying? And people are walking out with bags and bags of stuff. All right, it's Christmas, it's Hanukkah, it's the new year, it's colder, it's warmer, they need clothes, but they're spending money as if they had it.
Well, in many ways they do. That's a controversial topic. What is the true excess consumer savings rate? I see some things it's come down to under $1 trillion. This is all since the pandemic. I've seen other things where it's up close to 6 trillion of excess cash that consumers have. I just did a podcast with my friend Vincent Delaward. I think one of the smartest guys. He's based in San Francisco, StoneX. He's their chief strategist, and he makes the point that we're likely to have a strong economy from a nominal GDP standpoint because there is so much money that's in the system. And you look at something like the Social Security increase that just happened, which was almost 9%, and that's a good example. So a lot of dollars being injected into the system, but of course inflation's been running about that same level, so it's kind of on a real basis not that much. But of course, what really makes the economy go around is nominal GDP. So I think we could have a fairly decent nominal GDP year next year, but a recession in terms of real growth. But you're right, it's weird. Like so many things today, it's just a lot of it is almost out of Alice in Wonderland.
When somebody calls you, Sean, are
Mhm.
they concerned about inflation and the recession?
Absolutely. They're trying to protect the dollars they have, the extra bucks. If it's not already invested or not already otherwise spoken for, the last thing they want to do is just let it sit there. And it's good because it shouldn't just sit there. It should be doing something to either help make you money or help secure your household. And so, precious metals have been one of those things that as long as you give them enough time, they will keep up with the rate of inflation and typically beat it. The question is how long? And you'll get some people who call us and they'll think I can just sell this in 6 months, in which case I never recommend that. But it's kind of hold it till you can't should be the approach. And of course, that's different amounts of time, and so their results are going to vary. But certainly, that is a great use of those dollars is getting invested in precious metals.
And our next program, Sean and I are going to talk about the long game with precious metals. So be sure to tune in for that. David, what can people do to, one, preserve wealth, preserve what they've got, and hope that we're not like Italy or Germany pre-World War II, when shopping bags full of money would go into a market to buy a loaf of bread?
Well, yeah, that's a legitimate fear. I mean, we've obviously had a lot of regular inflation, but the hyperinflation is what you're describing. And the U.S. has got an awful lot going for it that post World War I Germany, Weimar Republic Germany didn't have. But I think we're playing a dangerous game. I think the assumption that the U.S. dollar will always be the reserve currency, the world's reserve currency, is a bit arrogant on our part, frankly.
Mm-hmm.
I think we're moving toward where our currency, or to be the ongoing reserve currency, and it'll probably be more than one, will be backed by a basket of commodities. I think that just how reckless these governments have been since Nixon took us off the gold standard back in '71, and you look at what's happened to deficit spending since then, it's just shocking. And I mean, that's what I worry about is when you look at one of my predictions for next year, as I mentioned, is a U.S. funding crisis, because I think we're going to be looking at a deficit, that's somewhere around $2 to $2.5 trillion. And the Fed is also selling about $1 trillion worth of bonds, which is also going to kind of swamp the market. You've got Social Security, which now has to sell treasuries to pay the benefits because the benefit outflow is greater than the amount of money coming into the Social Security Trust Fund. You got the Bank of Japan selling treasuries. You got the Bank of China selling treasuries. They're buying gold, by the way. If you look at central banks around the world, they've been big gold buyers as they're divesting treasuries. So it's a scary situation. I don't think we're on the verge of hyperinflation, but the way these idiots are acting in Washington, with this latest, I mean, it seems like every month there's another major program they had put forward to spend money they don't have. And where's
Does
that
it
money
seem
ultimately
like
going to come from? Pardon
does
me?
it seem like there's a point of no return? I mean, I remember when billions got normalized as a figure, and now we're into trillions. I mean, is there a point of no return where you can never pay that off and never get caught up again, or something that resembles being caught up?
We can never pay off the debt that we've got from a federal. In fact, just saw that if you looked at, it was in the Wall Street Journal today, a good op-ed piece, that if you look at entitlements, unfunded entitlements, the total federal debt is over $100 trillion. Jeff Gunlock from DoubleLine, who's down in your area, brilliant, the best bond investor on the planet, says it's 1.6 trillion. It's a massive number. I'm sorry, 160 trillion, not 1.6, 160 trillion. What could be 1.6 trillion is the amount spent on interest alone this year. Probably be a little under that, but these numbers are just staggering, and they can't. The economy is not big enough to be able to service them. That's why I think ultimately the Fed's, what I call their magical money machine, will have to kick in again.
But in recent history, we have paid off the debt. The Clinton administration, and maybe that's too long ago, but I remember that.
No, it's a good point. It's a good point. I can remember vividly Alan Greenspan worrying publicly that we were going to be out of debt. There would be no treasury market by 2010. And I remember saying that's crazy because we're going to have recessions and these politicians love this, but we were on a very good path. And it's hard to believe, that's one of the points of my book, is how far we've fallen, how fast we've fallen in 23 years. But the trend that we're on right now is terrifying, frankly.
Yeah, I wonder if we really truly understand the damage being caused while trying to create things that are supposed to help people. I don't see how you can do both. I think as a taxpayer, it seems incredible.
Yeah.
There just simply isn't enough tax revenue. You would have to absolutely kill the economy. And then you get into this counterproductive mode where the more you raise taxes, like the more you raise interest rates, the more it depresses the economy, which then reduces tax revenues. So you get into a chasing your tail kind of futility circle. And so, yeah, it's a tough one. And that's, I think we're going to see that really hit the fan first with what Jay Powell's trying to do. He's trying to do the right thing. He's trying to get the interest rates up to the inflation rate. But that's going to be tough. Now, I do think inflation is going to come down, so there could be kind of they could get similar, maybe even a little bit above. The Fed funds rate could get a little bit above the inflation rate for a brief time period. But again, if you go into a severe recession where government revenues decline and entitlements explode, social support spending explodes in recessions, then once again, the tougher he is on the inflation front, the worse it's going to be for the economy. So right now, he's clearly making the choice. I want to try to control inflation. But later in the year, I think he's going to be under enormous political pressure to ease off and to, for the younger people, frankly, 4 to 5 to 6% inflation, that's pretty good.
Yeah.
Because their income will go up with that. They don't have a whole lot of assets that are being depreciated. But for the 50 to 60 to 70, 80-year-olds, I mean, it's a disaster. They're losing purchasing power. Even if you're getting people say, "Oh, I can get 4%, 4.5% on a short-term treasury," great, but you're still losing money to inflation.
Mm-hmm.
One of the things that worries me is what you just said. Our young people. You're a grandpa. You told me you have 6. I don't know if you can remember all their names at any given point.
As I get older, it gets harder, but I still can.
Exactly. So you have 6 grandkids. Do you worry about their future?
I do. I absolutely do. But I guess where I really have my concerns is this decade. I think this is going to be a tough, problematic decade, but I'm actually fairly optimistic about the 2030s. I tell that to some of my clients, well, that's too late for me. But,
Right.
some people are saying 2040s, but I think part of it is that a lot of the problem that the government has is because of our generation, yours and mine, Mark. Sean, I don't think you're considered to be a boomer. You look too young to be a.
Gen X for year one,
There
1965.
you go. Okay. Well, you're close. You're right on the cusp.
I'm on the cusp.
On the cusp.
My birthday is too. I'm Aries or Pisces if I want to claim it, one day.
But I mean, you're an exception to this. But for the most boomers or the older, certainly the older cohort, like my brother and sister, they're going to be, we get into 2030s, a lot are going to be dying off, already are. So a lot of these unfunded entitlements will eventually be eliminated by the Grim Reaper.
Mm-hmm.
And then we can get kind of a reset. I think we're going to get a reset anyway before that, with some, as I mentioned earlier, some kind of new currency. But I think the era of fiat currencies is coming to an end. Now, will that be next year? Probably not. I just think it's going to be a very stressful year. As I said, a very stressful decade.
This is BullionMax, the podcast. I'm Mark Alyn, along with the customer service manager for BullionMax, and that's Sean Reynolds. Our guest is David Hay from the Haymarketer, right? Haymarketer?
Haymaker.
I can't even write. I can't read my own handwriting. Haymaker podcast and newsletter, and they're free. And we'll have free. So we have information on how you can subscribe to those up here on our screen. What is hot, if you will, for just a brief moment or two right now, Sean, at BullionMax?
Excuse me. Right now, what's hot is fractional gold, particularly 5 gram, 10 gram. This is for people who are feeling they may be bartering with their metals or using their metals as money in the future. And the reason they're looking at this is because the premiums on that amount of gold is considerably less than a stack of silver that would have a similar value. And so now people I've been talking with, we're talking about trying to get the most affordable money for you going forward in the event that that's what you feel your investment is how it's going to be used.
One of our recent guests, David, told us that he didn't think we really were in inflation. He said it's a supply chain issue caused by the pandemic. We couldn't work. Factories were closed down because people were getting sick. And the numbers now show that those numbers are going up again. Will this ever end? Who knows? But what's your thought about supply chain?
I think it's valid. I don't think that's the whole answer any more than I would say that the fact that money supply increased by 40% 2020 and 2021, that was the only cause. I think it was a multi-factor issue. But I mean, we created a lot of money in this country after the global financial crisis with QE1, QE2, QE3, and unofficially QE4. But you didn't have that massive fiscal stimulation that you had post-pandemic. It was those two things, along with restriction of the supply of goods, that was just like the perfect storm for inflation. Mm-hmm. And some of that is easing, but you could make the argument China's trying to reopen, but they're having a heck of a time. I mean, it sounds like the COVID infection rate in China is just going ballistic. Mm-hmm. So that could create supply chain issues again, because China is still obviously a critical supplier of the world. So I think that stuff will reoccur. But in general, I think we're going to get a temporary dip in inflation during the first half of next year. And some of these longer term inflationary forcings are, I think, more durable, like deglobalization. I know some people like to poo-poo that, but I just think that's a reality. So I think that's
manufacturing coming back to the United States. I mean, we learned a heck of a lesson that we can't just have all of it done abroad, because then you have trouble getting it manufactured, sourcing materials, getting it here, getting it through ports, all of that. Do you think any of American industry learned the lesson to say you just can't do that?
Well, I think absolutely. I think that will happen to a much greater degree than it has. And that is, I think, a longer term inflationary factor. I also think the energy is, because, I think I coined the phrase a few years ago, greenflation. We talked about it last time, that this great green energy transition is highly inflationary. For the first time in human history, we're going from more denser forms of energy to less dense forms of energy, and unreliable. I mean, in Scotland, I just saw this in the New York Times, that 61% of Scottish citizens this winter are looking at energy poverty. their energy prices over there are astronomical. 30% of their power comes from wind, and the wind hasn't been blowing. So it's a very high risk, highly inflationary energy transition we're trying to make. So that's a factor, but there's a lot of other factors as well. But just the fact that there's been so much money created and so much deficit spending that's happened, and then that I think is going to have a long-term tail to it in terms of higher inflation.
In Ireland, aren't there politicians like ours, full of hot air, and they could go out to
stand by the turbines?
Yeah,
you would think so.
You would think. Do we have a United States economy, a China economy? Are we really a global economy? Because what happens here affects China, Finland, throughout the world.
Well, certainly the monetary policy of the Fed does. I mean, I think it is fair to say the Fed is for the time being, the world central bank. So that's just one example. But I do think that global order is really going into a global disorder. I think that paradigm you described is fracturing. And, I just don't think that's going to immediately reverse and that we'll be singing Kumbaya with, the Chinese and the Russians anytime soon. So it's there's a lot of forces out there which I think are going to make inflation more enduring.
The war in the Ukraine, while we're not actively involved, we are passively involved.
We sent a few dollars there, I think. Is that right?
Exactly. Yeah.
Is it 65 billion? Is I think the appropriation that's before Congress right now for Ukraine in this latest.
Yeah, and again, it's billion with the B, which has been so normalized. It's like people couldn't even fathom that many dollar bills in a room if somebody just stacked them up. And you went, "Oh, that many! Wow, now I care." It just seems like things cost things, and we just need to do this. So go, just whatever. That is very frightening.
We've all become anesthetized, or like when you're in a car going 80 miles an hour on the California freeway, which almost everybody does.
Yeah,
you get velocitized. You kind of get used to it, but it's really isn't normal, and it isn't. The more important thing, it's not serviceable. We cannot service the debts that we've accumulated, and that's why I think all roads lead to the Fed monetizing the debt through some type of QE methodology. They might call it something different than that, but I think that will be the net effect. So I think you guys are, I think you're doing great service for your clients.
Would you say, you just use the analogy of going 80 miles, and I don't do 80 miles. If you're watching and you're a CH,
you're one of the few.
Yeah, one of
They've got
few.
cameras.
I was 78. I top it, but the highway patrols and curbs all that supposedly fast racing on the freeway. Who's supposed to be checking up on inflation and the supply chain and and recession? Is that the Feds?
Who's the cop for the economy?
Who's the cop?
Yeah, I think the Fed is the closest to that. They certainly their mandate keeps expanding. I think too much. So I think that's another. In fact, speaking of an inflationary pressure that's be long lasting, I think one of the biggest problems we've got is the politicization of the Fed. It has become much more of a political animal than it was. They've lost their independence. And I really do think there's one of their many mandates, a stealth mandate, is funding the U.S. government. That may be, again, unacknowledged. The last thing they want to do is say that. But I think in reality, they know in their heart of hearts that's what they have to do. So again, you just add all this stuff up, and that's why I think we have a decade staring at us much more like the 1970s, although in the 1970s, we actually had relatively low debt. And by the end of the 70s, we had the debt to GDP federally down to about 30% versus about 115 or so recently. So Volcker could take interest rates to 20%. But now they can't even come close. Powell is having a heck of a time getting the Fed funds rate up to the inflation rate, whereas Arthur Burns in the 1970s was, derided, went down in history as this monetary wimp. But he at least got the Fed funds rate above inflation in times like 1974, which was also a nasty recession. So
in the 70s, the inflation rate or the interest rates were like 14%.
I believe you got the Fed funds rate to 11% briefly in 1974. Then inflation fell hard, and then interest rates fell hard. But then, of course, inflation took off again, and so you had double-digit interest rates in the late 70s, even before Volcker got. Volcker got in 1979, but then that's, of course, when it really got serious. I mean, that's when he got the Fed funds rate 8% above inflation, unprecedented. And of course, it did the trick, but it was a brutal recession. But again, much lower debt levels. Trying to do that today is impossible.
And I guess the next part of our show, the next couple of minutes, what should people do? What would David Hay recommend that people do to preserve what money they have as they can?
Well, it's a lot like what you guys say. I'm constantly telling clients because we manage money. Our total assets under management are about $3.5 billion right now. So, that's my day job is, how do we position our client portfolios to deal with the realities out there? Not what we hope is going to happen, what's actually happening. And I think, I always say this, invest in scarcity, much like what you guys do. And certainly gold and silver qualify. I also like uranium a lot. I think uranium is greatly underappreciated right now. There's the Sprott uranium ETF, and that's trading, I think, at 1075 right now, and I think that easily could hit mid-teens this coming year. But energy is another area.
I'm sorry, David. I believe California is allowing at least one nuclear plant to continue.
Diablo Canyon, correct. But it's what's happening even in Japan, which obviously had the Fukushima disaster, so they went very anti-nuke, but they're now reopening nuclear plants, and China's going huckly-buck with nuclear, and India's going. And I also think what's coming on is this move towards small modular reactors, and I'm just making an investment in one that I've got I won't mention private anyway, but I think it's based on naval technology that's been proven since the 1950s, and these are all a whole bunch of ex-Navy nuke people. But there's going to be, whether it's them or other people, there's going to be, I think, a revolution in terms of small modular nuclear reactors and batteries. So that's going to be part of, I think, the 2030s renaissance. So I don't want to be gloom and doom here, but I think we just have to be realistic. We've got some challenges that we've never had, maybe outside of the 1930s in this country. But again, in the 1930s, we had very little debt. When you have a whole lot of debt like we have, and it's not just the government debt, it's all this leverage in the system. You may have seen that the Bank for International Settlement just came out and said there's something like $70 trillion in FX swaps based on the US dollar. These things are all intertwined and very complicated. And if they start blowing up and the chain reaction that triggers, I don't know if that's going to be it, but there's just a lot of frailty in this system.
Well, we are out of time. We thank you, David. Happy New Year to you and your family and your staff.
Thank you. Same to you guys.
Thank you. Will you come back in a couple months and
anytime for you guys
again?
Anytime. I love chatting with you guys.
All right, that's great. Sean, as we wrap up here, any thoughts on what's available right now as we begin 2023 in the precious metals market?
New Year coins. We're going to start seeing a lot of the 2023s very soon. We already have the Philharmonics and the Britannias. We'll get more in just as each mint releases the next year of coins. Late January for American Eagles, in case anybody's wondering about that. And so we'll be there to acquire any and all of that stuff to make it available through BullionMax.
And we should also mention that shouldn't there be King Charles coins coming out?
Yes, might take half the year to get them out. So even though there's enough advance notice, there's still, supply chain that has to get caught up. There's still, dies to make and also commissioned images that need to be approved. That apparently is the big time waster right there. Which picture do you like?
Well, I thank you both for joining us here on BullionMax. Sean, I'll see you on our next episode as we talk about the long game. And David, look forward to connecting with you in a couple of months and getting another update from your perspective.
Likewise, Mark. Thank you very much again for having me on your show.
Thank you
Bye,
very
guys.
much. We
Throw
appreciate
some
it.
haymakers, David. Throw some haymakers.
Yeah.
Watch out, J Pal.
And as always, I forget, but this time I didn't. If you would like, subscribe to us. And here's a subscribe button. Just tap it and you'll be able to get all the information from our new episodes as they are released. All right, for Sean Reynolds, I'm Mark Alyn. Thanks for watching.